Afternoon. We are going to give a quick earnings kind of scoreboard so far here as we're kind of halfway through the earnings season. Talk a little bit about the jobs numbers that came out last Friday and wrap up our conversation with a great question from Cindy about why there seems to be a difference in the stock market and the bond market's reaction over the last couple of weeks. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday at 3 is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a little bit of the noise along the way. And certainly have a lot to cover here this week. So as a forewarning, this is, especially on the earnings scoreboard, is going to be a little data heavy. But I think as we wrap up our question of the week, hopefully we'll balance that out a little bit too. It is nice to see a little sunshine, by the way. So if you're in the Pacific Northwest, hopefully you're enjoying this lighter weather here lately. All right, so before we get into the kind of core of our conversation, I do want to touch on some jobs data that has come out recently. We do these every Thursday, obviously, and so we talked a little about jobs last week, but to tie it all up in a bow, we also had Friday jobs numbers come out. We had the non-farm payrolls report come out last Friday, and so I wanted to make sure to touch on that. Basically, what we saw was that there was a huge jobs number actually on Friday. In the month of January, we had added over 350,000 jobs, and the expectations coming into this data point was actually closer to around 180,000. So almost double the expectations coming into this last Friday. And I think, what we kind of saw the market react to sort of kinda, and I'll talk about this more as we get to our question, is basically this was another sign that it's very unlikely the Fed is going to cut in March. Now, we've been focusing on that the last couple of weeks since the press conference. The Fed had reiterated that. But again, every time we get these data points, I think it just highlights that a little bit more. Now, you may remember from our conversation 2 weeks ago that basically what we got out of the Fed was that it seems like maybe the jobs and economic markets are not nearly as in focus as they once were. They're really more focused on the inflation data in and of itself, not that they haven't been in the past. But obviously, if there is any change in that to the negative, it could come back into play. This was just another sign that maybe they don't have to worry so much about the jobs market and they can really focus on the inflation data. With that, unemployment still low, as you might imagine, at 3.7%. What is interesting, though, I had shared this a couple of months back and had heard from Brian Westbury, an economist, an interesting report talking about the average number of hours worked. And what has been interesting about that is that although the unemployment and the added jobs look great, the actual hours worked has been steadily coming down over a long period of time. So he had put together a really strong report just kind of talking about how those two have kind of not balanced each other out, but it makes the jobs numbers look not quite as exciting as they might seem on the surface. So with that, we also had initial jobless claims today come back down. You might remember last week it was a bit of a spike, but we're back down to a more normal 218,000. So jobs certainly seem to be strong, I guess would be maybe the constant here. I do want to spend a bulk of our time talking a little about earnings so far. So here we are. It is February 8th as I am sharing this today. And what I'm going to talk about, I can kind of maybe share some updates as we get through the rest of earnings season, but I do want to go back to some data points as of last Friday. So keep in mind, earnings through this week are not going to be factored into this. But nonetheless, I did want to touch on some of what we're seeing so far in some of the earnings season and where the sentiment kind of lies. So as of last Friday, it was almost half of the companies in the S&P. So I'm really focused on the S&P 500. Half of the companies had reported earnings. And remember, when these companies report earnings, what they do is analysts have expectations going into these calls. So they say, okay, Apple is expected to have this much in revenue and this much in profit, basically. And the earnings calls, one of the big focuses is, did the company beat those expectations or miss them? Now, I want to highlight before I go too far into what we've seen so far, that a lot of times those analyst expectations might be a little bit lower than the reality of what has been shared or what they might see, because it just builds in a little bit of room for the upside there. So keep that in mind. Generally, there's a lot more companies that beat expectations than don't, because of that kind of natural, discrepancy there. And also keep in mind, beating expectations does not always mean a positive thing, right? So earnings expectations could be a lower expectation than their historical averages, but if they beat that, it looks good on the surface. So just keep that in mind as I go through this as well. All right, so going into last Friday, we had basically 72% of the companies, just over 70% of the companies had beaten their earnings expectations. And 65% or so, right around, let's say just between 60 and 70 had beat revenue expectations. So this is kind of, it might be a little bit higher, but let's say right in line with kind of typical beat estimates, I guess, if that makes sense. And one of the things I did want to highlight is blended earnings. So now you look at all these companies that have reported, again, about half of the S&P 500. So let's call it 200 to 250 companies. All those companies' reportings, the question is, how much are earnings actually growing? So rather than expectations, how much are earnings growing? And so far, as of last Friday, that growth number was 1.6%. And the reason this is important is going into last week, that number was actually down, and it would have marked a second, negative earnings report. Now we'll see as earnings continue to shape up, but so far it's at 1.6%, which is basically right in line with expectations. So in general, if all these things are kind of in line with where we thought we would be, you might expect not a lot of movement necessarily in the markets around this news. What is important, though, is that when companies report earnings, they also share their guidance moving forward. They talk about not just what has happened, but what they expect to happen moving forward. And what I wanted to touch on here is that 31 companies has shared at that point, shared that they kind of expect negative guidance. In other words, what they had expected prior, they've kind of reduced. It doesn't mean they're going backwards. It just means maybe not quite as profitable or as high as earnings as they had expected the prior quarter. And 17 companies had issued positive guidance. So again, just the opposite, right? They had expected better now. So that is kind of where we stood last Friday. And again, at the time I'm sharing this data, we were about halfway through the earnings season for the S&P 500. So we come back to this as well, but I figured as we were halfway through with a little lighter data this week, this would be a really good thing to cover. Be sure to tune in next week. We will cover on Friday. Tomorrow, we get a CPI inflation seasonal factor revision. On Tuesday, we get another inflation data point. And then on Thursday, we also have retail sales. But before we break, we got a very good question from Cindy this week, basically asking why the bond market is reacting so differently from stocks lately. And it's a very good question, and it's very in the weeds because I don't think a lot of people track the bond market nearly as close as the stock market. But over the last few weeks or so, since the Fed talk, there's been a lot of movement in the bond market and very little in stocks. And what we've seen is that interest rates in the bond markets have actually picked back up quite a bit, not quite to the highs that they were late last year, but they picked up a lot. And that actually is a negative for bonds because when interest rates pick up, bond prices actually fall. So when you think about that, and then you think about what stocks have done, stocks have gone up through the course of the year so far. They are actually working in opposition, which typically is a good thing, but it's also showing that there's some sort of discrepancy in how the stock market is looking at the data versus how the bond market is as well. And I think, to answer your question, Cindy, is that most of this is coming from speculation around the Fed. I think that the bond market has taken very much to heart what the Fed has shared about not cutting rates for a long time. And I think the stock market did for a day or so and then just kind of brushed it off. So I think that's really what we're seeing here in terms of the discrepancy between the two. This is not, I hope this doesn't come out the wrong way, but a lot of times it is referred to that the stock market is the dumb money and the bond market is the smart money. I wouldn't necessarily say that's the case, but that's like the old, stigma. And so, it is interesting to see that discrepancy because if the stock market does start to pick up on some of that as well and start to react a little differently, obviously we could see some volatility return there too. And again, it doesn't mean interest rates have peaked again. It just means that there was a lot of this optimism, which may sound weird, but optimism that the Fed was going to cut rates in March. And the bond market is definitely reacting to the Fed's rhetoric that that's not the case. The stock market seemed to have reacted for a day and shrugged it off. So I appreciate that question. Hopefully that's helpful to the rest of the group as well, because it's a very, very good one and something that is a little more detailed, but worthwhile to cover for sure. So thank you all for joining us here this week. I hope some of the earnings scoreboard and then also this update on stocks and bond market was helpful. Be sure to tune in next Thursday for inflation data and retail sales.